Hello, friends, clients, and colleagues. This is Richard Siegel with ARQ Wealth Advisors, and today is Sunday, August 27th, and it's time for a market and economic update. We're going to talk about three things today. The first being rates and inflation, the second is the economy, and then the third is the capital markets. So we'll kick it off with rates and inflation. That's mostly in the news today. And you'll see here that this is the fastest rate hiking cycle in history, this red line here. The black line here was in the early 80s under Paul Volcker when they raised rates all the way up into the high single digits, and inflation was in the teens. But we're at 5.5% now, folks. That's the highest Fed funds rate we've seen in decades. And therefore, you're seeing CDs and money markets paying very nice interest rates. Now, why are they raising rates so much and so fast? Well, it's to beat down inflation that arose from the pandemic era monetary and fiscal policies. So you can kind of see here, this is CPI going back a couple of years, and you can see we peaked out here right around 9% in June of 2022. And most recently, we were at 3.3. So it's working. The Fed uses the PCE deflator number, which actually comes out this week. And their target is 2%. And right now it's in the high threes. So they really want to get down to that target. So they are basically telegraphing that they're going to leave rates higher for longer and possibly even raise rates another one or two times. But we are definitely towards the end of this cycle. I guess what they don't want to happen is what happened here, where they took the foot off the gas and then inflation took off again, and then they had to raise rates a few percentage points higher. So they want to beat it down now, and that's why they're raising rates so aggressively. Now, with that comes higher rates on cash and money markets, but just understand that this is temporary. The Fed has a pretty bad history of raising rates and not breaking something. So if they continue this, the economy will go into recession. Things will, quote, break, and then they're going to have to lower rates very quickly. In fact, here's a great way to look at this. Over here, we're at about 5.5%. The Fed, FOMC, their own estimates, 5.6 for the high of the cycle, and then getting down to 3.4 in the next couple of years. And their long-term target here, it's highlighted, is 2.5%. So enjoy these high rates while they last on cash. It's not going to be forever. It's probably going to be in the next year, 6 months. It could be 6 months. It could be a year and a half, 2 years, but this is temporary. So today, cash is a viable investment vehicle because it's outperforming inflation. However, it's not a long-term viable investment vehicle. All right, getting back here to the economy, pretty crazy. The consensus for this year was a recession. We still think we're going to have one, a mild recession in the next year or so. It's really being avoided because of the consumer. You can see here that the unemployment rate is 3.5%, historic lows. Anyone that wants to work can get a job. However, job openings are starting to deteriorate. The Atlanta Fed GDP Now model is literally showing a GDP forecast for this quarter, Q3, of 5.9%. Pretty shocking. That's far from recession, but you can see here, this is what makes up the GDP forecast, right? These kind of teal-colored bars are consumer spending. We are a consumer-driven economy. What you're not seeing here under the surface is that consumers are starting to take on more debt. Debt servicing is becoming a greater portion of the consumer's monthly expenses. So that's not great under the surface. That's what's happening. The excess liquidity that came about through the pandemic is dried up, and now more debt is being built up. So that's why we think the consumer is going to stop this here eventually in the next couple of quarters, and we may go into recession. So Coming down here, this is the conference board, and the conference board is a government-sponsored data aggregator, a think tank, if you will, and you can see here that by their own measures, they are estimating a shallow recession here, Q4 of this year and Q1 of next year. Now, they've been wrong, but this is what they're estimating based on their data. So what does a recession mean? That means a contraction of economic output, obviously with a 5.9% estimate for Q3. They're far off here, but this is a weekly estimate, and this moves around quite a bit. So 5.9 would be quite a surprise to see it stay that high as we get to the end of the quarter. Capital markets. We talked about cash. Bonds look fantastic. This is the best bonds have looked in almost 20 years. We'll touch on that more in a second, and then we'll touch on the equity markets. So here is a couple of screenshots right here. These are two bond holdings that we actually as a firm hold for our clients. And what you'll notice with this one here is that the bonds in the fund are 2.25 years in duration. So that's considered a short-term bond fund. The average credit quality is A+. That's very high credit quality. And then the yield to maturity is 6.85%. So what you're basically getting here is almost a 7% total return potential over the next couple of years. You want to buy bonds when rates are high and prices are low, and the average weighted price here for this fund is under par. This is a very attractive investment opportunity. And then over here, same thing. This is actually a mortgage-backed fund, Fannie Mae's, higher credit quality, a similar yield to maturity, and a cheaper price. So these bonds look phenomenal. Again, cash looks fine for now, but the Fed could lower rates by 1 or 2% in only a few months' time if they need to. And when rates come down, bonds go through the roof. So we think bonds are probably the most attractive asset class out of the three main classes today: cash, bonds, and stocks. We haven't seen these opportunities in about 17 years. Over here, as far as the stock market goes, a couple things to consider. One is that this is large cap growth. So these are these tech stocks, Magnificent Seven, we could name a few: Microsoft, Apple, Amazon. What this basically means is that those stocks are trading at a 34% premium to their own 20-year historical average valuation. They're expensive. It makes us nervous. And the forward price to earnings ratio of the S&P, because they're so heavily weighted in those stocks, is 18.5 times earnings on a forward basis, also expensive. Okay, we are biased towards these highlighted areas here: value, mid cap, small cap. You'll notice here that the equally weighted S&P 500 is trading at 15.75 times earnings. Much more attractive. And then all country world index, ex-US. These are foreign stocks trading at 12.6 times earnings. Another way to look at this is this chart here. US, you can see here that these purple bars are the 25-year average valuations. Here's where we were at the beginning of 22. That's why the market did lousy last year. And even today, it's gotten cheaper, okay, but we're still trading at a premium in this country based on the S&P. Down here, Japan, you'll notice that Japan looks very attractive compared to its 10-year, 25-year average valuation. Europe looks very attractive. Emerging markets look about fairly valued. And China, which we have some money in, but they're having some structural issues, so we have been a little lighter in China recently. Again, cheap relative to historical valuation. So the point being here is that there are some really good opportunities in the stock market, but they're not in these large cap, mega cap tech stocks today. They're really in the mid cap, small cap, and value sectors like financials, industrials, energy, materials, etc. Over here is one last chart I'll show you today, and this is basically it's going back to the early 70s, and it's saying that the top 10 stocks as a percentage of the entire S&P 500 capitalization are pretty much at the highest level since the early 70s. And that's a little scary because you could see what happened there. Okay, and then over here as well. This is the tech bubble. So essentially the top 10 stocks today are a greater representation of the S&P 500 index than they were in the tech bubble. And what tends to happen is when these stocks have an outsized representation of the index, they go through this 10 or 15-year de-concentration period, meaning that either they will come down quite a bit in price or they'll just lag for a decade. And that's what happened. If you think back 10 or 15 years ago, Microsoft was dead money. It didn't do anything until about 7 or 8 years ago. So again, we think the real opportunities in the stock market are not in the mega cap tech stocks going forward. It will be more in the foreign markets, small cap, mid cap, and value. So at this point, we're a little tentative. We like the cash because it's 5.25% ish with no real risk at all. The bonds look fantastic and parts of the stock market look reasonable. We are a little bit underweighted in stocks in our client allocations, and we think we'll have better opportunities here as prices tend to either come down a little bit. August and September are not the strongest months of the year for the market typically. They tend to be volatile. So we think that we're poised for some volatility and the cash on the sidelines. Again, this is the first time we've had this chance in a while. So while we wait and earn over 5%, we could deploy that into a cheaper stock market when opportunities present themselves. Thanks very much and have a wonderful day.